I'm going to do a quick follow-up on yesterday's um, video on the stock market. There was always a chance that this could just be a one and done daily cycle low. It's starting to look that way. The S&P hasn't actually completed a swing yet. It would need to go above 38, 37, I think, in order to complete the swing today. It may still do that before the close, but um, it's like I said, it's really starting to look like this is just a one and done daily cycle low. And I warned that this is what could really bring in the retail buying and power the final, you know, phase of the bubble. When a really scary correction like this gets recovered almost instantly, it just confirms that there's no risk in the stock market, and then the retail traders, mom and pop, they all uh, see it as free money, and they start to pile in, and these are unsophisticated investors. They're not placing limit orders. They're placing market orders. They're willing to buy at any price in order to get in, and that's what causes the final phase of a bubble. So we'll have to wait for an actual swing before I would be um, willing to call this a final daily cycle low. But so far, this just looks like another one of these brief little corrective moves in an ongoing runaway move, and this one was deep enough to turn that 10-day moving average down. So um, enough, in my opinion, anyway, to qualify as a daily cycle low. Once we get that swing, um, assuming we don't go back down again tomorrow, but if we get a swing, then I would say we're now on day one of a new daily cycle, and probably ready to continue the second phase of the bubble. And again, as I said, I'm pretty sure the bubble is going to be in tech. I have been I've liked mostly the semiconductors and the small caps. Um, I suggested subscribers this morning, go ahead and take a half position just in case that was the daily cycle low. But I suggested at this point we want to rotate out of semiconductors and small caps and go into the really liquid, the QQQ for the rest of the bubble phase, just because there's a lot more liquidity. It's going to be a lot easier to get out when it's time for that. We may give away a little outperformance in the semis and the small caps, and I don't mind um, giving away a little outperformance if that were to happen, in order to have the extra liquidity of one of the most liquid ETFs in the world. The only one that might be more so would be the S&P, but at this point, I think my advice to subscribers was just to switch over, get in the QQQ as opposed to the semiconductors and the small caps, and we'll just ride the rest of the bubble in this and not worry which one is going to outperform. It's just going to be easier to get out when the time comes if we're in a really liquid um, vehicle. The two most liquid are the QQQ and the SPY, but I think tech is going to vastly outperform the SPY. So my choice would be the QQQ at this point for the rest of the bubble.